I do want to talk about supply, if we can start there. We've got $48 billion of 3-year notes this week. We've got $40 billion of 10-year notes. We've got some 30-year bonds, $24 billion worth. These are big, big numbers. That's Treasury supply. What's happening with credit supply going into year-end?
Good morning. Thank you both for having me. So as you know, credit supply had a bit of a flurry of activity in September. It calmed down in October. I do think with this tentative stability in the Treasury market that corporates, CFOs, and treasurers may look to move ahead before the year-end seasonal slowdown. It will be an important test for the market how this Treasury supply is digested, but as we know, the Treasury Secretary guided us towards the front end of the curve and not so much in duration in the refunding announcement last week. But I actually think, if nothing else, the past several months have shown corporates that this can be very episodic in terms of these windows opening, and so given that we know the maturity walls are coming up, I think for corporates it's better to issue early rather than late. We're expecting a big week in the IG market this week. I think expectations are a little lower in high yield, but I would not be surprised if we surprise to the upside in terms of those expectations, because I think it's just prudent for CFOs.
Which speaks to kind of the opportunism that one syndicate desk told me about last week. He messaged me as soon as we saw this rally, and he said, everyone's trying to come to market. I've gotten 15 phone calls. Everyone's basically lined up. Is this going to be bad with credit spreads widening in this sort of counterintuitive way because we've got more supply?
Yeah, I think the appetite is there, and I think we've had such light supply, especially in high yield year to date, and 22 was a record low level, that I think the appetite for the market is there. I think where the real risk is at that lowest quality cohort of the CCC market, that kind of lowest quality rung of high yield, which are CCC issuers. There, I think we've seen some enhanced pressure where it's weak results coupled with refinancing needs have really pressured those capital structures. And even on this swift rally in high yield spreads that we've seen over the past few trading sessions, CCCs have rallied, but they've lagged on the way in. And I think it's the market telling you that there's an appetite for a certain quality cohort in the credit market. IG, I think, is there in most market conditions. High yield is a bit more tentative, but for that lowest quality rung, I think it's very case specific and very idiosyncratic.
Are people kind of just pricing in perfection here?
Well, with high yield spreads below 400, it's hard to argue that there's much risk premium added into the market at the moment. I think what we're seeing is a lot more focus on selectivity from our credit investors. So thinking about asset allocation between high yield and leverage loans, sector selection, issuer selection. I think where high yield spreads are at the moment, the path of least resistance is probably a little bit wider in terms of choppiness with some of the headline risk ahead of us. But again, as we've talked about before, where yields are, it's really difficult to see kind of high yield spreads breaking out in this range of much wider from here, because every time we tried to reach 440 last week and we kind of snapped back in, and so there is a bit of a tug of war between fundamentals and technicals, and even the most vulnerable fundamental pockets of the market have been the best performer, like leverage loans.
You mentioned the decision set between loans and, say, high yield. Help our audience understand what goes into making that kind of decision and whether that's changed in the last few weeks.
So it has changed in the last few weeks for a few reasons. One is if you think we're at the end of the rate hiking cycle, if you think we've seen stability in long end rates, you might think that the bulk of the loan outperformance is behind us at this point. And indeed, that yield pickup that leverage loans were offering over high yield bonds has narrowed. So what we are seeing is a bit more interest, say, even within capital structures of investors saying, okay, well, I'm in the loan, should I rotate into the high yield bond? Or given the fundamental pressures of this higher for longer rate environment that we're expecting, are loans disproportionately impacted by that because they've been contending with it for a longer time? Again, we don't view fixed rate bonds as immune from that in many instances, but I do think on the margin, given the strong performance of loans year to date, there is some refocusing on, okay, is the bulk of that loan performance behind us?
Breathe some life into that just a little bit more. We saw a big equity move last week.
Yep.
If you're looking at and I know it's unique and idiosyncratic, but ultimately just give us the 35,000 foot view. If you're looking down a capital structure right now, is the bias to be higher or lower in it?
Actually, I think the high end of the high yield market has actually outperformed the low end of the IG market. So it's not as clear cut as saying be underweight high yield versus IG. There are a lot of nuances there. I do think for choice, I would prefer to be higher in quality within high yield. In IG, I think moving down into that BBB cohort is a relatively nice place to be. For the most part, the vast majority of those corporates are committed to maintaining investment grade ratings. You are picking up a bit of a spread pickup relative to the highest rate cohort. And I think that's important in this current environment, especially if we don't get a severe downturn in growth.
So I don't mean to be overly basic about this, but when you take a step back, I do wonder if we do coalesce around this higher for longer kind of idea.
Yep.
Does it make sense that we're not going to get any kind of major default cycle, either in public credit or in private credit, if we're looking at benchmark rates that are 5 percentage points higher than when all of these companies were borrowing in bulk not so long ago?
It's a great point, Lisa. So we are seeing a modest uptick in defaults. We're at just under 5% in the U.S. when you combine high yield and leveraged loans. That's well off the rock bottom levels of 2021 and 2022. Do we break out to the levels that we saw in COVID, 8.5%, 9%? I think barring a severe downturn, I don't see it. Part of the reason is that corporates have entered this period in a really strong position. The other part is that the investor appetite, to your point, John, is there. And then third, I would say corporates are actually shifting to a more balance sheet friendly posture. So we haven't seen a lot of debt funded M&A. We haven't seen a lot of debt funded share buybacks. They're still investing in CapEx, still investing in debt repayment in terms of uses of cash. But I do think corporates do have some discipline. I think the real risk is that if there's a severe downturn in growth coupled with just a capital markets freezing such that these corporates don't have access at any price, I think it's difficult. As for the private credit point, historically we look at losses between the two markets, and private credit losses have held in better than public credit losses. Part of that is because the enhanced flexibility that those corporates have. We think that holds true, but I think the point remains we're expecting an ongoing normalization higher in losses across all those asset classes. Not extreme though.
Given where we know where the maturity wall is,
yes.
Can you identify what would be the least optimal time to have an economic downturn? And is that what's basically on the horizon now?
So I think probably the biggest risk is that if corporates try and time this opportunistically, they let the year end play out, they think the environment will be better in the first half of 2024, and then we have some sort of shock, whether that's geopolitical, unforeseen risk contraction. We're watching bank lending very closely, although that has actually played out, I think, a bit more benign than we would have thought. That is the risk. I think that if corporates try to be almost too strategic about the timing and they cut it too close. We saw that in the financial crisis where some corporates were shut out. So that's why I think if I'm a CFO or a treasurer, better to issue early rather than late.